Hello friends, it's Castaway Trader. Happy Sunday. Today we will be talking about the deep corrective move down in the stock market, and we will discuss different scenarios. So the whole idea is to understand whether the drop has bottomed or how deep it can keep going down. This is a monthly chart of S&P 500 that I posted in February 2020, and I provided you with two targets. Target 1 was 2900, 2750, and target 2 was 2475, 2300. And this is an updated chart, the same chart but updated last Friday, and we can see that the first move down actually has stacked target number 2, and in this video we will be discussing whether that bottom made last Friday was a lasting bottom. Should we expect market to keep moving lower, and how high we can expect a bounce after that move down, and whether it's the first leg down or the whole corrective wave 4 and we can expect continuation of the rally to new higher highs. But before we start, I want you to read that important disclaimer. Remember, trading is risky and past results are not indicative of future profits. This is how my website looks like. It's located at www.castawaytrader.com. Here you can read more about my subscription plans. You can click here, you can click there, you can check my video courses, and you can start a trial today for only $39.99 if you want to get updates on the website, or you pay $49.99 for 15-day trial of my premium trading chart. I want to start with discussing two questions. I have personally found those questions even silly questions, but it seems like many people are not sure about the correct answer to those questions. And the first question is, can Elliott Wave theory really predict the price? I'm gonna show you several forecasts I made last week, and basically those forecasts help my subscribers to make good money. It helped them to navigate those rough times in the market. So let's spend 5 minutes just to watch those examples. So the answer is the Harmonic Elliott Wave theory is a great tool that can really predict the price. I highlight that I'm talking here about the Harmonic Elliott Wave theory, not the classic Elliott Wave theory. So let's look at those charts. Tuesday, March 10, I post the chart at 7:50 a.m. and all the charts I'm gonna show you today were posted both in my premium chart and on my website. So those charts were available for my subscribers. I posted that ES extended higher overnight, but I still expect a deep bearish reaction in subwave B down. And I provided two scenarios. You see those red lines, and those both scenarios suggested that price may drop lower and then bounce again to a higher high. And again, it's very important to understand that many people keep saying you cannot trade Elliott Wave theory because it provides a lot of ambiguity and you cannot get a forecast which would be like 100% reliable. Guys, you should understand that if you trade the market, you have to embrace uncertainty. And what's great about Elliott Wave theory, it teaches you to deal with uncertainty. It urges you to keep thinking about different scenarios. And when you have two slightly different scenarios, when both of them point in one direction, this is when your forecast of the market becomes your trading setup. This is what majority of people don't understand, that there is a huge difference between forecast and trading setup. And let me show you how it worked that time. Again, Tuesday 7:50 a.m. Tuesday 9:49 a.m. We got the first move down as we expected, and I'm posting another chart providing more details, more insights into that potential move down. I'm saying, okay, so that move down should be structured as ABC down. We can get a pullback and B up, which would make a lower high and another strong push down. And together, that formation would be recognized by many traders as inverse head and shoulders reversal pattern. Tuesday, 12:15, look at that. We got B up as we expected. It made a lower high and another strong push down, exactly what we expected. And now we have that inverse head and shoulders. This is left shoulder, head, right shoulder. And I'm saying to my subscribers, okay, we are going to move up. And it looks like start of subwave C up. Again, we expected in the morning before the market even opened that it would be move down, retest of the lows, high low, and another strong move up. So we got 12:15. 5 hours later, we got the first move down as we expected. The question here, are we going to get that move up? Again, this is the actual timestamps. Everything were posted for my subscribers at that specific time. And 2 hours later, it's starting slowly. And this is exactly how 5-wave structures normally start. You get ABC of wave 1, ABC of wave 2, and only then the more energetic part of the move starts in wave 3, which is what I wrote. The first micro squiggles labeled as 1 up and 2 down, 1 up, 2 down, return the target area for the rally in between 2870, 2902. That rally has to complete a large corrective wave 4 up structured as ABC. What that means is that was A, that was B, that is C. Corrective wave 4 means it's a temporary bounce. That means, you see, my target is red box. Red box means it's resistance. That means wave 4 means there should be wave 5, which would push price down again to lower lows. Let's see how it worked. 3:59 p.m. the very same day, I told you there will be wave 3, the strongest part of the rally, and this is exactly what happened. It pushed the price from 27.55 to 28.70. Remember, 28.70, exactly what I promised. Look at that red target box. This is where price stopped that day. That was Tuesday. Okay, and just compare the projection. ABC down. We got that ABC down, and move up. So let's continue. That was Tuesday, 6:24 p.m. And I gave a bigger picture. So in my service, I keep switching from higher time frame to lower time frame. So I want my subscribers to understand what's going on different time frames. And this is exactly why I love Elliot Wave theory, because it helps you easily to connect in your mind those different time frames. So you understand what's going on a weekly, on a monthly, on an hourly chart, on 5-minute chart. And depending on your preference, you can trade different time frames using the very same set of fractals, of repeating patterns. And you will see that I keep using the very same small collection of patterns. This is why it's easy to use. It's very easy to learn. You can learn that methodology from scratch. It's not like a rocket science. You know, everyone can do that. I totally believe in that. That was the top made in February 2020. We got first move down in leg A, corrective leg B, and the final leg C has to be structured, has to be subdivided into 5 waves, wave 1, 2, 3, 4, and 5. So at this point, I'm showing to my subscribers, so hold on, we have not tapped yet. I'm still expecting another push down, ABC down. This is my target where the drop may arrive from 25.50 to 24.70. Just pay attention to the current price at the moment I posted the chart. It was 28.70. 380. So I expected that price would drop for another 350 points, and as you know now, this is exactly what happened. Okay, this is Thursday morning, 9:41. That was our wave of 4. Remember, I showed you the scenario where it should drop in A, B, C down. This is the actual chart. This is A, very small b, and the final drop C. That wave C, in parentheses C of wave 5, was supposed to have 5 waves, and wave 3 is always the strongest. 1, 2, 3. And this is when in the morning, remember, we closed trading, we halted some limitation, and 15 minutes market did not do anything. So I posted an update saying that they may open ES at 2500, but I envision a pullback to 2600, 2620 in wave 4 up. And this is exactly what happened. Market opened 10 minutes later under 2500, and this is where I started to buy triple ETFs, and I posted it in my premium chart. We bought SPXL, I think UPRO, and in matter of minutes those triple bullish ETFs just jumped in value. Okay, this is what happened. We opened under 2500, and by 10:56 you see we got the first push up in subwave A, and I posted we are getting a pullback in wave 4 up as expected. What you should remember about wave 4, it's normally is structured as A, B, C. Once you get the first push higher, you normally expect retracement in subwave B and the final push higher in subwave C. Again, what you should remember, I keep teaching my followers, my subscribers every day, very simple rules. In any corrective A, B, C, the final subwave C is normally the strongest. And so basically what I'm showing here at 10:56 a.m. is that expect a pullback which would retest the lows made early morning. That shows that normally what we should expect is that push down, corrective push down, would make most likely a higher low followed by a very strong rally making higher high in comparison to the high made by the first push of the low. This is what happened next. 11:50, 1 hour later, exactly what we expected. We got B down, making a higher low, and that C of 4 is still on the table. Boom! 107, so basically 1 more hour, and we got that move up exactly in the way how we expected that. But again, what wave 4 means? Wave 4 means it's a temporary pullback. That means we need to expect another push down in wave 5, which most likely be structured as ABC, and which would target lower low under the low made by wave 3. And this is what happened. We got, that was wave 4 in the previous chart, you see, and we got A down, B up, and very short C down. And this is Thursday, 8:49 p.m. And this is what I wrote to my subscribers. Yes, has enough waves to complete the whole corrective ABC down structure that started at the top in February 2020. So far, the very final subwave C of wave 5 has reached the absolute minimum extension at 76.4% of subwave A of 5. This is what I'm talking about. Wave 5, that final wave 5, is subdivided into A down, B up, and C down. Normally C is longer than A. In a limited number of cases, subwave C could be 76.4% of subwave A. And this is exactly what happened here. So it dropped a little bit lower than 2400. But you know what happened next? Again, my forecast was we are dealing with a major bottom. We should expect reversal, bullish reversal. Boom! When we woke up the next morning, we got price that actually rallied for more than 200 points overnight. But again, I said, wait a minute, just don't get super bullish. We got the first move up, we should expect a pullback, the very same fractal. Look, in this video I keep showing you the very same fractal and it keeps working nicely. Okay, and again the same story. Look, we got left shoulder here, we got head, the lowest low, and we need to expect come back down, which would retrace 50% of that rally, at least 50%, which is what I'm talking about here, which would come back to the fake triple bottom, which was basically broken down here. And that would be a great entry point for bulls if you did not have longs on the way up here. This is exactly what happened. Again, that was posted at 8 o'clock in the morning. 4 hours later, we got a corrective ABC move down into that red target zone, 50% retracement, beautiful entry. And at this point, I'm saying, okay, we got ABC down, that red C stretched to 123.6% extension of red A, subwave A. And this is a very common extension for subwave C in a corrective ABC structure. So what we expect here, our expectations did not change. We remember we wanted to get moved down, retest of the triple bottom, and followed by another strong rally. So we got that move down, retest of the triple bottom. We still expect move up. It's Friday, 11:58 a.m. And this is basically what we got by the end of Friday. We got that rally, which almost tagged that red target box, which is 100% extension of the first move up of the low. So you can see that basically Elliott Wave theory, in particular its modified beta version, the Harmonic Elliott Wave theory, can do a great job navigating you through rough times in the market. Now, many people ask the second question, which actually drives me nuts. They say, can you really make money using Elliott Wave theory? And the answer is hell yes. And let me show you what my subscribers wrote to me over this weekend. Just 2 letters. I got a bunch of letters after that brilliant trading week. I'm gonna show you only 2 letters. First, the market just had a 30% correction, but my accounts are at all-time high today. Thank you, Castaway Trader. It's Kenneth. Kenneth is a subscriber of my premium chart. He's from New York City. Thank you, Ken. The second letter is longer. Hello, Castaway. I have been subscribing to your services for approximately a year now after following you on stock tweets. Since then, I have turned a losing account into 30% profit on my account with 95% winning rate. So basically, when I show people my winning rate, my personal winning rate, they normally don't trust me. And this is a guy who is not an expert. The guy is just subscribed to my service and he just follows those setups I post. And it's amazing. You can just read it. I wouldn't waste your time to read like the whole story. It's just to my subscribers. Thank you, Marka. He's from Reno, Nevada. Again, you should understand that past results are not indicative of future profits, right? So those people found a way to use my analysis to consistently make money. And I'm very, very happy of them. I'm very proud of them. But I strongly believe that methodology is easy to comprehend. It's easy to learn. And what I'm trying to do every single day, not only to give you setups, not only to show you my trades in my premium chart, but I'm trying to explain why I take every single trade, what the setup is behind each trade, why that setup looks like that, how you can find the same setup on your own. This is what I think makes my service special and this is why I strongly recommend you to give it a try. And this is how my website looks like. You can read more about what my premium trading chart is if you click that button. You can start your trial if you click that button. If you do not want to spend that much money, if you feel experienced enough in the market, so probably you do not need to be part of my premium chart, which basically, in my opinion, is the best product I have. You can try to use Market Focus. It's a standard plan which would give you access to updates I post on the website. But again, if you are part of my private chart, you will be able to ask questions throughout the trading day. Okay. This is how that standard plan looks like. You can read more about that subscription plan at castawaytrader.com/subscription rates. And this is my premium product. You can read about that trading chart on that page, and I will provide the links to those pages in description of that video. Okay, now let's come back to the most important topic of this week. Have we really bottomed, and what we should expect from here? Again, this is the chart I posted in February 2020. We got two targets, and I was actually amazed how quickly we sliced through the first target zone, 2900, 2750, but the real destination for a bigger pullback is always the low made by wave 4 of 1 degree lower. You see that wave 4, this is actually the bottom made in December 2018, and this is where we should expect a very strong support. And I talk about that specific rule of thumb in my professional video course. I provide many examples, and we study that pattern in depth. You can give it a try. Okay, so we got the drop to that green target box. Was it big enough to be all of wave 4? And if we judge by the size of that move down, sure, it's big enough to be all of corrective wave 4, and that means that we could expect wave 5, which has to be structured as A up, B down, and C up, targeting new higher highs. But I have a problem with that scenario. And the problem is that whole move up from the bottom of wave 2 to the top of wave 3 lasted for more than 8.5 years. And the first drop we got at ABC drop lasted less than a month. I just don't think it's big enough, it's lengthy enough to be considered the whole wave 4. So most likely, in my opinion, we are dealing here with a bottoming first leg down in subwave parenthesis A down, which itself is subdivided into ABC. And once it bottoms, we should expect a large pullback in the corrective wave parenthesis B up, that one, which would follow by another long and deep move down in the very final subwave parenthesis C, and together that A down, B up, and C down would complete a large corrective wave 4 down. This is the 5 wave up fractal. This is what I mean. So when you get the wave 3 up, the strongest part of the rally, which in my opinion topped in February 2020, you should expect a corrective wave 4, which normally retraces substantial part of that preceding rally. Normally it can retrace from 33.3% to 41.4% to 44.1% to 50% of that rally. Again, you can take my introductory video course where I explain in details how that wave 4 normally behaves, what pattern it normally follows, and what retracement ratios we should apply. But my point is that normally we can expect that the first move down, that tremendous, scary move down, was only the first leg down in subwave parenthesis A down. The problem here is that that monthly chart gives us a great big picture, so we can see what's going on a biggest picture. Now, to see the microstructure of that move down, we need to zoom in, and we're gonna to zoom in to 60-minute chart of S&P 500. Let's do that. So this is wave 3. You see those green retracement fips? Those are most common retracement ratios. This is where we can expect that first move down stop. So we can see 41.4. This is 44.1. Those are 24.33 and something like 23.77. And we could say that wave 4 down, the whole A down, B up, C down, can go much lower. It can extend to 2000 because the critical support for that whole structure is located at 1810. That wave 4 cannot violate that law, but it can get very close to that. Moreover, you could see that normally the second leg down may get under the top of subwave A of 3, which is located around 2116. So if you really want to get a nice, reliable, and high probability long-term bullish setup, you wait for A down, B up, C down, which goes slightly under the top, because what I keep teaching my students is the major tops tend to become major support zones. So we always have support zone underneath the top made by that previous rally. Another rule of thumb: when you have concerns, when you have doubts whether the first deep move down was big enough to be considered all of wave 4, you use very simple trick. You add MACD, a standard indicator, to your chart. That indicator can be found in every single charting platform. I use very standard inputs: MACD 12, 26, 9. So the rule of thumb is that as long as MACD holds over the zero line, wave 4 is not over. In majority of cases, MACD would at least tag the zero line, and in many cases it would go under the zero line, and that would be a great sign that we are dealing with wave 4. At this point, as you can see, we only got a bearish cross of MACD. That means that most likely wave 3 on that large huge degree is over, but that also means that wave 4 is very far from being over. Now, when we focused market moves inside corrective waves, we normally use the very standard fractal repeating pattern, which can be found again and again on different time frames, from monthly to weekly to daily to 5-minute chart. You see them everywhere. My idea is that first ABC down of the top of wave parenthesis 3 up made in February 20 was the first leg down in subwave parenthesis A, and once it bottoms, we should expect a corrective ABC down, which could be big enough to retrace at least 33.3, 41.4, 50%, or even 61.8% of that move, strong and scary move down we got in February, March. So the question here for traders is, can we be sure that first move down bottomed last Friday? Let's talk about that. This is a micro counting of the move down. So I showed you that my personal approach is always to go from a bigger picture to a micro picture, because you can only nail micro turns in the market if you understand a bigger picture really well. So we started from a bigger picture. I showed you we are most likely in wave A of 4, right? And it's structured as ABC. What's really important is that in any ABC structure, wave C should have an impulsive structure. What that means is that it should have 5 microwaves inside of that wave C. And here on the chart, I call it a bullish scenario. It's 1 down, 2 up, ABC of 3 down, ABC of 4 up, and the final ABC down. What I like about the chart is that it bottomed in the zone, in the green target box, which is built upon extensions of the first leg down. So we measure the first leg down, we project it from the top of a corrective wave B up, and we get typical extensions like 109.2, 116.4, 123.6. The main idea here is that wave C gets longer than wave A. And you can see that in this particular case, wave C almost tagged 123.6% extension of wave A. Okay, that's good news. Now I'm gonna show you why that scenario does have some flaws. So the problem here is that when we deal with the final wave C, as I mentioned, it has to be structured with 5 microwaves. And if you focus on that very last segment, wave 5, it has to be subdivided into ABC, where corrective wave B up normally is well pronounced. The problem is, in this particular case, we did not have a well pronounced B up. And believe it or not, but those small details, they matter. Okay, so if we have a problem with that bullish scenario, if we have some concerns, what we should do is that we need to find another scenario which would better explain what happened. And this is the bearish scenario I have for you. We got that ABC up on Friday, and every time I see that ABC with very energetic C up after a major bottom, I become concerned. I become concerned because it looks corrective. When we have so much enthusiasm in the close of Friday, I started to close my longs, and I reported that in my premium chart, because it just started to look too cheesy, too easy. And this is what we have here. So what if we can count that move up on Friday as wave 4 up? Then we got, remember, wave C down has to have 5 waves. We got 1 down, 2 up, ABC of wave 3, meaning that on Friday it was bottom of wave 3. And then it followed by A up, B down, C up corrective pullback. Again, if bulls want to prove that bearish scenario is invalid, they've got to push it higher to over 2882, because in any 5-way down fractal, wave 4 has to hold under the top made by corrective subwave B up of wave 3 down. As long as we hold under that critical resistance, that bearish scenario is very well alive. So what we can expect? So let's assume, so this is what's gonna happen. This is the primary scenario for now. So we can expect that first we would get an impulsive drop in subwave A that would retest the lows made on Friday, and in case of ES, it may retrace the lows made overnight from Thursday to Friday last week. Then we should get that well-pronounced corrective push up wave B, which has to make a lower high under the high made last Friday at close. And then we should get the final push lower. And that could be a deep push lower. That could stretch to 2000 easily. It could stretch to 2200. But because it has to be structured into 5 microwaves, when we will be watching it, we will be able to pinpoint the exact top, as we did in previous examples I showed you in this video. And once we get those 5 waves, that would be a complete A down, B up, C down structure, and we will start playing with inverse head and shoulders pattern again. But what about that bullish scenario? Yes, it's still valid. I would say it's slightly less probable than bearish scenario, but what it should deliver on Monday and Tuesday to make us confident that actually the bottom was made last Friday. So instead of a strong push under the bearish scenario, retesting the lows made last Friday, we should get a corrective looking ABC down, which should make either a higher low, that would be an ideal situation, or it could retest that low, but the key, it has to be structured as ABC, and if we get that ABC, then we should expect another strong push higher in subwave C or wave B up. And again, this is how bearish alternative looks like. You should pay attention that I'm dealing with the very same pattern. The only question is where price is located in that pattern. This is what makes Harmonic Elliott Wave theory a great tool. You do not need to learn hundreds of patterns and fractals. You learn only a handful of them, like probably less than 10, and you just keep following them. So the whole way down, I kept posting in my premium chart and on my website the fractal like that, showing where exactly ES could be at that point. And in my opinion, it should help tremendously my subscribers, because they not only learn that fractal in the process, but that helps them to understand where we are and what we should expect and what kind of move we could expect next. So in conclusion, if this is what we got, before that Friday rally. If we get that A down, B up, C down on Monday, Tuesday, that would be a great bullish setup for a similar push higher to new higher high. But compare it to that structure. If we get something like that, like impulsive drop down retesting the previous lows, that would be a sign that we are dealing with a bearish scenario. Then that would mean that if we get A down, we get A up, B, C, like micro ABC, retesting part of the decline. That would be an awesome bearish setup, short setup for another push down to lower lows. Okay, I have 2 video courses, just briefly introduce you the whole idea because people keep asking me the same question. So that introductory course will teach you all the great foundation for that specific forecasting tool, the Harmonic Elliott Wave theory. It will show you the main patterns. It will show you how you identify them. It will show you what retracement ratios you should use for every wave, what extensions ratios. It will explain you what retracements and extensions are. It will introduce you to the idea of Fibonacci numbers. It will show you some other most common retracement and extension ratios which are derived in a different way rather than from Fibonacci numbers. And you can start learning it from scratch. You do not need to be an expert in the classic Elliott Wave theory at all. If you are an expert in classic Elliott Wave theory, as I used to be, I would strongly recommend you to give it a try. Just switch to the better version of the Elliott Wave theory. And because only a handful of people on the whole planet use that technique, you would get a huge advantage. Because everybody uses the classic version, and the classic version sucks. Believe me, I used to practice it for 3 or 4 years. I labeled tens of thousands of charts, and since then I've been using the modified better version, and I assure you, you will love it. Just give it a try. The second course is a pro course. Why? Because it goes deeper into the very same area. It will review the same fractals, but I will give you more details, more tricks. Those tricks and ideas which I personally found by trading the harmonic Elliott wave theory. I'm not like a talking head who just talks. I trade. Last year I made over 2,000 trades based only on the harmonic Elliott wave theory, and my winning rate was around 80% for the whole year. So it speaks for itself. So in my opinion, it's probably the best analytical tool available in the market now. You can read more about those video courses at www.castawaytrader.com/education. You can read a lot of reviews left by students of those courses. Again, this is how my website looks like, castawaytrader.com. You can start your trial today. We normally start posting updates once the futures market opens at 6 p.m. Eastern time, and my last updates normally go out around 10 p.m. or 11 p.m. every day. Every time, like every day except for Friday and Saturday. Even on Sunday, I post overnight updates for those who trade from Europe or who do not want to sleep, which is a great mistake in my opinion, but it's your life, you can do whatever. So, and we start new updates from 8 or 8:30 a.m. in the morning, well before the market actually opens. And I showed you several examples of those updates posted early morning. Again, this is how those premium chat room and standard plan pages look like. You can find all those links in description to this video, and I would ask you to subscribe to my YouTube channel. I did not post much because hell, that market made me so tired you just can't imagine. But I will do my best to post more videos, and you don't want to miss them, just subscribe and you will get email notification once a new video is out. And please like this video, because to produce a video like that, you know, I have to spend hours. I just don't want to issue to release some crappy video. You know, there are like 50 charts in this video, guys, and I spent hours on that. If you like this video, I would understand that basically that time was not wasted. You want that video and you appreciate, you know, the time I spent. I actually stole from my family. Have a great day. It's still Sunday. Enjoy your life. We'll see each other later once the market is opened. Bye.